Good evening, ladies and gentlemen. This is Barry Norman on behalf of Alvexo, and welcome to our webinar on support and resistance. One of the most important concepts you can master when having to trade in the financial markets. Now, tonight's class is sponsored by Alvexo. Alvexo is one of the leading forex and CFD providers around the globe. Now, they only offer their services where they are regulated, and they hold licenses in many countries and zones around the globe. So if you go to www.alvexo.com and you're unable to log in or set up an account, it's because they don't offer trading because they're not regulated in your home country. But you should give Alvexo a shot. You can see the difference lies in the simplicity of their trading platform. Their online web-based trading platform is one of the most unique and easiest to use. It is very user-friendly, very easy to see, very easy to trade with. And if you want to trade in a more professional environment, you can download their MetaTrader 4 platform. When you trade with Alvexo, you get live customer support, leverage up to 300 to 1, all the types of analytic and financial and technical analysis tools, plus weekly reviews and live signals. You can enroll in their trading academy, and you get access to all their trading platforms. Now, their trading academy will turn you into the best trader you can be, whether you're an experienced trader or new to forex. Now, tonight's class is being recorded, and you can access a recorded version of tonight's class in about 24 hours by going to investing.com, where you signed up for tonight's class, and go to the education tab and then look for webinars on demand. And like I said, in about 24 hours, it'll be available there. Now, since Alvexo is a regulated provider, I need to read you a risk warning, and then we'll get on with our class. Trading forex, CFDs, and spread bets on margin carries a high level of risk and may not be suitable to all investors. You may lose more than your initial deposit and could be required to deposit additional funds. Please ensure you fully understand the risk and take care to manage your exposure. So let's get started talking about support and resistance. Now, support and resistance is one of the most widely used concepts in forex or cryptocurrency or CFD trading, futures trading. Strangely enough, everyone seems to have their own idea on how you should measure support and resistance. Now, these are fairly easy concepts. The concept of support and resistance forms the basis of all technical analysis decisions. Traders look to buy at or near areas of significant levels of potential support in an uptrend, and traders look to sell at or near areas of significant levels of potential resistance in a downtrend. Now, you may have heard the old business cliche, buy low and sell high. New traders usually ask the question, how low is low and how high is high? One way we can qualify these levels is using areas where prices stopped and changed direction in the past. The areas where price stops after moving up and then turns around is called resistance. Resistance acts as a ceiling, capping future advances in prices. Now, don't understand, capping doesn't mean stopping. So if you imagine support and resistance like an elevator, and the resistance is a ceiling above your head and the floor is what's supporting you, as you're moving up, you have to keep breaking through that level of resistance to make the next floor. When you break through that level of resistance, it becomes the floor below your feet, or it can turn into your support. And when price is moving down, it's just the opposite. So if you close your eyes and just imagine the floor and the ceiling of an elevator, and just whether it's going up or down, you can decide or determine whether these are levels of support or resistance. Now, the fact is, when price is moving down, resistance is where traders have a difficult time pushing through as it's moving down. When price is moving up, resistance is the same thing. It's the price where the traders tend to stop for a second. Doesn't mean it can't go through it, doesn't mean it won't break right through it, but it's where prices have in the past had a problem breaking through. Prices have had a significant response to that price. Now, if you imagine that as price is moving in an uptrend, it forms peaks and valleys because price doesn't move this way. Price moves this way, forming higher highs and lower highs, higher highs and lower highs. If I wanted to explain it to you in a simple, concise form, imagine buyers bought as price is moving up in this direction. Some price, the buyers are saying, that price is getting too high, I'm not going to buy anymore. Other buyers that bought earlier, I said, guess what? It's moved up enough that I've made profit. I'm going to start selling because I've made the profit I wanted. So you have one group of buyers who say the price is getting too high, I'm not buying. And another group of buyers who say, I bought earlier and I'm happy with the profit, so I'm going to take my profit. Well, as they sell and there's a lack of buyers showing interest in buying because the price is too high, the price will start to decline. At some given point, all those buyers who were selling to get out and take their profit are all sold out, and also the price is declining, and new buyers who are sitting who are sidelined say, that price has fallen low enough, I'm going to enter the market. And they do the same thing again. And this creates your level of support. When price eased down, at what point did the buyers re-enter the market? That forms support. When it moved back up, at what point was the market too high for the buyers to be buying up where the sellers were being bought up by the new buyers coming in? And that forms your resistance again and again. Now, when price is moving up, it can come to this resistance point, but there could be ample buyers who are still buying, even they're saying the price is getting high, but for some reason they believe that price is going to continue going straight up, so they're going to continue buying. But regardless of what happened, you will see that as price is moving up and reaches this level, it might not bounce down here to this support, but it might hem and haw. You might get congestion here, or you'll see lots of opens and closes or highs and lows touching this point before it breaks through. Now, some points are minor resistance points and other prices are major resistance points. Resistance is not just some random area where price turns around. There are potential sellers, traders who have sold a forex currency pair before and remember the collective power they had to push price lower. There are also buyers who went long as support and were disappointed the price did not go higher and will close their buy positions with sell orders. Another group that make up resistance are the ones that bought at or near resistance and are trapped when price fell at resistance. These traders are begging for price to come up one more time to get them out of at break even. So you have all different types of groups of the market that cause this momentarily response to the markets. Now, one thing to remember is support and resistance levels are not exact numbers. Oftentimes, you will see a support or resistance level that appears broken, but soon after finds out that the market was just testing it. With candlestick charts, these tests of support and resistance are usually represented by candlestick shadows, the wicks of the candlesticks pushing below a support line, but not being able to close below that support line. Support and resistance is common jargon for areas on a chart where price has a difficult time breaking through. Support levels tend to stop price from falling below a specific point, and resistance levels act like a price ceiling that price cannot break above. Knowing where these levels are make it much easier to decide when to close and open trades. But how can we locate these prices to begin with? Now, imagine, before we get into how we would locate these prices, imagine if you were looking at gold and you wanted to buy gold, and gold was moving up steadily, and it was trading at 1220, 11, say 1150, 1175, 1200. Okay, where would you want to buy? Well, if it was approaching a resistance level, you wouldn't want to buy at that point. You'd want to say, uh-oh, I want to see how it's going to react to that resistance level, because most likely it will bounce off that resistance. It may not go back all the way down to 1225 or 1250, but if it was putting up and hitting 1210, maybe it'll bounce back off of there to 1190. But you don't want to buy at a resistance level. You want to buy below a resistance level, but after it's tested that resistance level. If you want it to go up, you would actually much prefer buying that asset when it hit here, bounced off, and then went back up and broke through it. Because then you know it's not going to fall off that resistance level, it's going to continue its upward trend. If price was moving down here and was making a beautiful uptrend down, push high and push lower and lower, came back down to this level, this is where the level you might want to buy. You might want to wait till it touches that and buy slightly above when it bounces off of that support level. So there's many reasons you want to know these levels that can help you in making your trading decision. So one of the great ways to find support and resistance is to mark levels in the past where prices had a difficult time breaking through. As price moves up and down, each level that price has bounced off of could be a level in the future that price bounces off of again. Now, this is a manually intensive method and takes time to draw on all currency pairs that we trade, but can pay off in the long run. Now, I call this eyeballing. And I simply take, let me pop up a chart here. I take a price chart. Now, we're looking at the euro US dollar. It's currently trading at 117.7806. Now, now you can have a zillion support and resistance levels, but the most important and the most crucially important are to be the ones closest to the current price. So we want to see when price was in this area that it was trading at now, when it was in that area again, what price was crucially important? Where do we get lots of opens and closes on that price now? Look how many opens and closes, okay, we got on that level, that 117.825 that I just drew on there. Look how over this whole period trend, and this is going back until last week, how important that price level was. So that's telling us that, and look at this, we can see in the most recent bar that, and actually let me change the candlesticks because a lot of you like to trade with candlesticks. We can see that the top wick of that candle came all the way up here and touched that exactly that 117.825 and bounced off of it. Okay. We can see all of these prices here that were significantly important. We can see all these opens and closes on that price, and look at these back here, last week. Look at these two candlesticks sitting right on that price. The open and the close were significantly important. So that gives us, because remember, these are not laws. These are alert zones. So we now have a significant alert zone. Now, we need to have many of these. Now, we can look at another one that was right there. Okay, look at all these closes and opens we got here. Look at how it bounced here. Look at all these swing highs that we got that weren't able to violate it there. Look at the open and the close here. Now look as we got closer to today's price. So this is just giving us some general areas. That's it. Now we can get broader ranges also by locating swing highs and swing lows of recent price movements. So we could see when it was starting this rally down here that we had these swing highs up here. Okay. We can see when it came down and hit a bottom here, we got that swing low. We had this significant swing low here. We had a very important swing low there. We had a swing high here. We had a swing high here. We had a high there. So we could take all of those and also draw those. So we're going to take those and make them red because you want to understand you want to be able to color code your own support and resistance levels. Because you want to understand where you're getting from to figure out how important they are. Are they major or are they minors? Okay. Because then we can also start creating support and resistance zones using different ways that we accrue these numbers. So now we have two sets of important numbers on our chart. We have the blue line, which came from our, and this one should be blue also, which came from our support and resistance looking at common prices. Then we got these by looking at swing highs and swing lows. So all we know is we're getting some information. Now, we're trying to locate prices that have had importance to this asset in the past. So arguably the easiest support and resistance levels to add to our charts are pivot points. And pivot points are built-in indicators on many platforms, and they're mathematical calculations. Pivot points are created by the previous period's highs, lows, closes, and opens. Now you can get these pivot points with what's called a pivot point calculator, or you can just go to any forex or technical analysis site, and they'll provide them to you. We're going to go over real quickly, and we're going to look on investing.com and to see what we call a pivot point chart. So let me pop it back up here. So we're going to go over here and we're going to look at a pivot point chart. So what we can see here is pivot points. The only thing we're concerned with right now is classic. This is giving us on the euro, and it's trading at 117.78, and this is giving us the three levels above and below the current price. Okay, and these are based on mathematical calculations. Now we're going to quickly write these down and then put them on our charts. So I'm only going to, because we don't have much time in class, we're going to start with just what's called support 1 and resistance 1. They're the levels above and below the current price. So we have 117.71 and 117.85. Now we have to make sure, I'm sorry, I didn't make sure, that we're using the same time frame for our charts as we are for our pivot point calculations. So I didn't. So we're looking at 117.75 and 117.80 in the half-hour chart. So we're going to go back over this chart and we're going to put on a line here. We're going to make this line. We're going to make these lines. Let's see what color. We'll make these bright green. We'll make them dark green. And these are our pivot point lines. So we have 117.75. $117.75. Okay, and then we have 117.80. Okay, so this gives us the other support and resistance. So we have our greens, which are from pivot points. We have our blues, which are from eyeballing, and we have our reds, which are from swing highs and swing lows. Now, it gives us lots of lines on our charts. And we can make them narrower and thicker depending on it. We can also see at 117. Oh, excuse me. We can see at 117,785 where the prices just moved to, that it's stopped dead zone right now, right on a very important resistance level. And that close of that most recent candle was right at that level. So we can break through and keep going up, or it can fall down to that next level. But what we're doing is we're simply trying to isolate important prices above and below the current price. Now, once we've drawn these on our charts, they stay good forever. These lines do not lose validity over time, especially short-term time. So as price moves up and down through these, we can leave them on our charts and they can be projected forward. So we don't have to constantly draw them on, because the longer that they've held, the more important they become. So let's go back to my PowerPoint. There we go. So now we've added swing highs and swing lows. We've added eyeballing and pivot points. We've gone to the pivot point chart and we've located these. Now these numbers, these levels, come from market ebbs and flows. They go up, they come down, and they move sideways. The primary way we make sense of these movements are analyzing the price action, as well as the levels in the market where price bounced higher or rotated lower. We call these levels of support and resistance. Support and resistance levels form the foundation of technical analysis, as they help us build a framework from which we understand the markets. For price action traders, support and resistance levels help us plan our stop loss placement, our profit targets, and perhaps more importantly, these levels give us a way to make sense of the market in terms of ways it has done, or what it has done, and what it is doing, and what it might do next. So if we go over to our price chart, and what's one of the most important lines we can put on there? The first line that we should have had on this chart already would have been a trend line. So if we would have taken our trend line and drawn a good trend line on here, we could then start making some sense of this market, because we would expect price to move up and down through these support and resistance lines, where this trend line crosses a support line gives us more important of a number. So what we're expecting is price is moving, and it's constantly moving, but when we saw price here fall down and break through there, where did it stop? It stopped at that trend line. When price came down here, it hit the resistance line, didn't make the trend line, and bounced back off of it. So we could expect as future, we could expect this price here at 11773 to be a very crucial point, okay, because we have the trend line crossing a major support line. Well, we're going to look for some market action, and we would hope that price would bounce off that trend line and bounce off that resistance line and continue to make its uptrend, because you would think that this is in a short-term downtrend, but is really in a longer-term uptrend or a medium-term uptrend. And what we're having here is simply a retracement: push, ease, push, ease. And one of the major rules of this is that the trend line isn't broken at any given point, and that each push and ease is making higher highs and lower highs. So as long as this price doesn't break that trend line, it's really on a well-developed uptrend, and that uptrend is going to continue. So even though it looks like it's in a downtrend, it isn't. So somebody who's looking to buy would look to buy off of this price range to move up above this level, if not far up to that level. Each time, each one of these waves should be making higher highs and then lower highs. Push and ease, push and ease, push and ease, push, ease, push, ease, push, ease, push, ease. They don't look pretty, and it looks like the uptrend is over, and it looks like it's moving to a downtrend. But if you're actually using proper trend analysis, and proper use of support and resistance, you would have seen and you wouldn't have panicked at this price and sold. If you would have bought an investment here and saw it move up to here, ease down and move up to here and fell down here, at this point, you probably were selling, panicking and selling, when you should have been staying in the market to re-enter. If you're looking to buy, this is giving you a buy, not a sell signal. It's giving you an opportunity to buy. And you'd be buying in the direction of the trend. Now, perhaps the most important support and resistance levels are traditional swing lows and swing highs. These levels that we find by zooming out to a longer term trend, typically a weekly or possibly even monthly. This is where we get a bird's eye view of how price is moving within that trend. So if we were going to take this price chart, and we're not sure exactly where to put these lines are, if we were to take this 30-minute chart and move it out to a 1-day chart, okay, we could isolate more specific price ranges. Now here we have Fibonacci's on here. I want to take these off. But see, all of these price trends, these are the red, blue, and green lines we drew on here on a daily chart and a 30-minute chart. We can see the back end of those. Okay. Now we can see that this looks like it was an uptrend here. Then it looked like it went in a whole sideways congestion, and now we're actually in a downtrend. That's giving us a whole nother view of where price is headed. Okay. Now, this is on a daily basis. But we could also find the peaks, the highs and the lows in these peaks. And draw these swing highs and swing lows for longer term support and resistance lines and move them forward. So we have those lines here, but then if we were to look at, say, a 1-hour chart, because we were looking at a 30-minute chart, we could see more precisely, we might be able to see more precise zones, because it doesn't matter what time period you put on these charts, still telling you prices were critically important at these charts. So by isolating longer term swing highs and swing lows, we can pull these forward to our shorter term charts and have important price levels. These levels do not have to be exact. They may intersect price bars and they may be zones rather than levels. You can consider this the first step in regards to support and resistance levels, and then the first thing you should do when you're analyzing any chart. Next, you want to zoom down to a time frame, to the daily charts, to fine-tune our levels to something more. The daily chart is the primary time frame for finding trade setups, not for trading, but for finding trade setups. So it's important we understand the broader picture of the weekly chart, but also have identified the shorter term levels on the daily, the 1 hour, and the 15, depending on how you're trading. One key point to remember is that when you zoom into your daily chart or even your 4-hour, 1 hour, you always leave the higher time frame levels on your chart, as they are still very important. You have heard the old saying, old support becomes new resistance and old resistance becomes new support. This is referring to the phenomena of the market making higher highs and higher lows, or lower highs and lower lows. We should mark these stepping levels, and that's a good way to explain a support and resistance. They're stepping levels. They're like steps as they form. Then when the market breaks down or up, through them, we can look to trade on the retracements back to these levels, also known as trading the pullbacks. This also gives us a way to map the trend of the market. When you see this stepping phenomena, you know you have a solid trend in place. These levels are good entry points as well as points to define risk or stop loss points. You can place your stop loss on the other side of these levels. For example, in the chart, we can see a clear downtrend. As price broke down past the previous support levels, that level flipped to resistance level and then acted as a high probability entry level if price retraces back up to them. We can look to sell or buy at swing points even if they are not part of a trend. Markets spend much of their time, and this is an important issue, markets spend much of their time consolidating and in trading ranges. And although everybody out there thinks that markets are always in a trend, there are three types of trends. There's uptrends, downtrends, and sideways or congestive trends. Markets spend more time in sideways trends or congestion or in undefined trends, price moving up, falling back down, moving up, falling back down, having no rules, being all over the place, than it does in trends. Okay, finding a market that is properly trending is quite difficult. When you isolate them, then you want to use all of your abilities and all of your knowledge to use these as good trading opportunities. We can simply use the most recent swing highs and swing lows as points to define your next trade. And you can see it's simple in this chart, but anybody who trades this is out of their minds. Okay, this is like, reaching a knife that's falling. It's like there's always going to be swing low highs in the market. There's always going to be swing lows, but unless there's got some type of definition with support and resistance and obvious trends, okay, you're just throwing knives in the air and hoping to catch them. Now let's talk about dynamic support and resistance levels. And what I mean by dynamic is moving levels. In other words, moving averages. A moving average moves up and down according to what price is doing. And you can set it to consider a number of bars or time periods. So a moving average could also be thought as a dynamic support and resistance level. So my favorites are 21 and 50 period EMAs, or exponential moving averages. I like to use these on daily chart frames mostly, but they can also be used on weeklies. These EMAs are good for quickly identifying the trend of the market and for joining that trend. We can watch for price to test the moving average after breaking above or below it, and then look to enter near that moving average. Ideally, the market will have proven itself by testing the levels on the previous and balancing previously. So imagine a moving average above and below price is really clearing the noise out of the markets. And if you think of a moving average as a dynamic support and resistance level, guess what? Combining that with pivot points or swing highs and swing lows gives you three ways to identify a market. So here's an example of a 50-period moving average being used to identify a downtrend, as well as to find entry points within it. Ideally, we would look at a 1 hour, 4 hour, and a daily price chart action for signals near or that level on a retrace back through the downtrend. So you have trend lines that act as support and resistance, because trend lines are drawn underneath the price in an uptrend, and they are support levels. In a downtrend, they're drawn above. Now, what you can do is draw a trend channel with a trend line above and below the price, and it becomes support and resistance levels. But a trend line, by definition, is a support level. Now, if we were to combine a 21 EMA and a 50-period EMA, and we could see where they retraced or where they crossed over, we could then mark those as traditional levels. Then we have our 50% retracement. We're not going to go into Fibonacci retracements tonight because Fibonacci's alone take a whole class. But there's one number in the Fibonacci sequence, which is a 50% level. But the fact is, 50% has nothing to do with Fibonacci's. A 50% retracement level has been found to be so important to the market, it was combined into Fibonacci retracement levels. But independently on its own, it serves as an excellent support or resistance level. Now, I don't use traditional Fibonacci retracements and all their many extension levels. Now, there is a proven phenomenon that over time, markets often hold the halfway point of a swing. So if you can locate the previous trend and isolate what was 50% of that trend, that would serve as a support line. Okay. Now, this is partly a fulfilling event and partly just a result of normal market dynamics. So imagine here, we isolate the bottom of the move and the end of the move. Okay. We were to locate 50%, exactly half of that total movement, and isolate that and draw that price level on a chart. Look at that. When price fell back down, it touched that 50% level, bounced off of it, came back down to it. What's the definition of a support level? So when it bounced back off of that, we would expect it now. At this point, it didn't come down and touch it, but it's nowhere near that support level. Move back up, and we would then look for it to come near it again. But the definition of a support level is where the markets have touched that level and bounced off of it. So here we have twice that 50% level served as a good information point. Remember, it's not serving as a trading point. It's not telling you to do anything. It's telling you to watch. It's telling you to be alert and be aware. Now, trading range support and resistance levels can provide many high probability entry points for the savvy price action trader. The main idea is to first identify a trading range, which was basically just price bouncing between two parallel lines. Price is stuck in garbage. Okay. A sideways moving market. Okay. Then look for price signals at those levels or look to fade those levels on a blind entry. Now, this is nothing different than trading that congestion I showed you with swing highs and swing lows. It's absolute insanity. Okay, by the fade level, I mean if the market is moving up and at the resistance level of the range, look to trade the opposite way. Okay, it's total insanity. Trade with the trend. Follow the rules of the market. Trade with the trend. The final type of support and resistance we're going to discuss today is event areas. Event areas are a proprietary form of support and resistance. Event areas are key levels in the market where a major price action event occurs. This can be a big reversal or a clear price action signal, either which led to a strong directional move upward. Now, these become difficult to find. Okay, these are basically areas that the market, when it was doing something crazy, came up to. Okay. So in other words, we had this event area. It was an event. We saw this huge pin bar. We saw this huge candle. Okay, this is a market event that we could have marked and drawn on our chart and brought it forward. But they're hard to define. Okay, so in the example of the chart here, you can see a clear event area was formed after strong bearish reversal bar on the weekly chart. Okay. And we could call that the event area. As price approached that level on a retrace some months later, we would have wanted to be sure to have that level on our charts. I don't know if it really helps you with anything. I don't know if you can really find them. I don't even know if they're worth bothering with. But now that you know the basics, it's time to apply these basics, but extremely useful technical tools in your trading. We want to make things easy to understand. And we've divided how to trade support and resistance levels into two simple areas, the bounce and the break. The bounce, as the name suggests, one method of trading support and resistance levels is right after the bounce. Many retail traders make the area of setting their orders directly on the support and resistance levels and then just waiting for their trade to materialize. Sure, this may work at times, but this kind of trading method assures that a support or resistance level will hold without price actually getting there yet. You might be thinking, why don't I just set an entry order right on the line? Well, that is possible, I assure you that, and you're assured the best price. But number one, because support and resistance levels aren't defined specific prices, trying to hope that they're going to hit an exact level is difficult. But when playing the bounce, we want to tilt the odds in our favor and find some sort of confirmation that supports that the support or resistance will hold. For example, instead of simply buying right off the bat, you may want to wait for it to bounce first before entering. So like what I'll do is I'll set up a limit order slightly above the support level. Okay. Or you can set up an OCO order, one cancels the other, slightly above the support level and slightly below the level of turns resistance. And let the system, if it breaks through and goes down, buy it going down. If it breaks through and bounces off, buy it after it bounces off. But don't ever try to buy it directly on the level. So if you're looking to go short, you may want to wait for it to bounce off resistance before entering. By doing this, you avoid those moments where price moves fast and breaks through support or resistance levels. From experience, catching a falling knife when trading forex can get awful bloody. Then the other way is to trade the break. In the perfect world, support and resistance levels would hold forever, McDonald's would be healthy to eat, and we'd all be flying around with jetpacks. In a perfect forex trading world, we could all jump in and out whenever price hits those major support and resistance levels and earn loads of money. But as we all know, that's not happening. So the fact of the matter is that these levels break, and quite often. So it's not enough just to play the bounces. You should also know what to do whenever support and resistance levels give way. Now, there are two ways to play breaks in forex trading: the aggressive way and the conservative way, depending on what type of trader you are. So now the aggressive way, which unfortunately is what we find most people that are trading in the markets today, the simplest way to play breakouts is to buy or sell whenever price passes convincingly through a support or resistance level. The key word here is convincing, because we only want to enter when price passes through a significant support or resistance level with ease. We want the support or the resistance area to act as if it just received a karate chop. We want it to wilt over in pain as price breaks right through it without stopping. In the conservative method, imagine the hypothetical situation. You decide to go long the euro US dollar, hoping it would rise after bouncing from a support level. Soon after, support breaks and you are now holding on to a losing position with your account balance slowly falling. Do you accept defeat, get the heck out and liquidate your position, or B, hold on to your trade and hope price rises again? Now, if enough selling and liquidation of losing positions happens at the broken support level, price will reverse and start falling again. This phenomenon is the main reason why broken support levels become resistance when they break. And as you've guessed, taking advantage of this phenomenon is all about being patient. Instead of entering right after the break, wait for price to make a pullback to the broken support or resistance level and enter after the price bounces. If your choice is the second, then you'll easily understand this type of forex trading method. Remember, whenever you close out a position, you take the opposite side of a trade. Closing your Euro USD long trade at or near break even means that you'd have to short the Euro USD at the same amount. So conclusion, we have gone over the major types of support and resistance and how I use them as indications for market conditions, levels to look at buy and sell from, levels to find risk, and as a framework to understand what the market has done, what it's doing, and what it might do next. When you combine a solid understanding of support and resistance level of the price action and market trends, you have a triumvirate of trading and a great way to start your trading strategies. So support and resistance doesn't have to be confusing. We can mix and match any of the methods, create a healthy amount of price levels that we can trade. As always, practice makes perfect. So make sure to test out these methods before using a real-time method, before using real money. Use a real-time demo account and see if you can master these. So on that note, I'm going to say goodnight to everybody. Thank you very much for joining us and have a great trading week. If you go to www.alvexo.com, enroll in their education academy, watch some of their videos on support and resistance, and get some one-on-one help. Thank you very much and have a great trading night. And again, thank you for supporting Alvexo as well as investing.com. Good night now.